Hi everyone, my name is John Locke. I'd like to welcome you to The Winning Trade. But first, the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that in this presentation, we are using a hypothetical computer simulated trade. It is believed to be as accurately represented as possible, but keep in mind that live results can vary for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance coach and mentor with Locking Your Success LLC, where myself and my team are here to help you win in the markets and in life as well. Now, in a moment, we're going to be going over the winning trade, but before we do, let me quickly explain what I mean by an income or high probability trading strategy. An income strategy is where we put ourselves in the position to generate profits through the passage of time rather than depending solely on price movement alone. This means that we can often make money whether the price goes up, down, or sideways. Now, that doesn't mean we're going to win all the time, but it does mean we're in a much higher probability situation than we would be otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockinyoursuccess.com. That's LOCKE-in-your-success.com, or ask a question in the comments on this video, and we can direct you to where you can find more information. The winning trade we're looking at today is called a bull trade, and it's amazingly simple. Now, the bull is what I call a stage one trade within our trader success blueprint, meaning it's a beginner level strategy, but don't let the simplicity of that strategy fool you, because this trading strategy has a very impressive track record of averaging a 20% annual return since 2002. And during this time, we have had years with returns as high as 65%. So it's an extremely powerful strategy. And the numbers we're talking about are pretty impressive when you consider that most mutual funds more under 10% per year annually for the same period. So what I'd like to do first is give you the complete rule set. So what we do is on Wednesday, or I should say the Wednesday, that's the closest to 65 days to expiration, what we're going to do is we're going to enter a 30-point wide bullish vertical on the Russell 2000 that gets us a credit of $2.50 per contract or more. From there, it's really simple. If the market is up or if the market's stagnant, then we do nothing. If the market goes down, we're going to want to look at the position and just get an idea of, what kind of shape it's in and whether it's a problem on the downside. Meaning that there's a lot of times you literally don't even have to look at the position on a day-to-day basis. Now, we're going to, from the point which we enter and we start monitoring the position, we're going to exit under two conditions. The first condition is if we have a drawdown that's greater than the credit received, which is approximately $2.50 per contract. Or the second exit is going to be if we run out of time, and we run out of time when our next monthly cycle is 65 days to expiration, or when the next trade is being ready to enter. Of course, you could do these on weekly cycles. If you do, then you just want to make sure that you go 4 weeks instead of going a whole calendar month. Okay, so this position is going to require a minimum of $2,750 per trade on the Russell 2000. If that is too much money for your account, or if you'd like to trade with less capital for another reason, it can be done in the IWM with as little as $275. On our $2,750 position, however, our exit loss trigger is going to be $250 per contract, and in the event we have one contract, that is $250, and if you're on the IWM, it's going to be $25 per contract for a maximum loss. In the example we're going to demonstrate for you today, it's going to be 10 contracts on the Russell 2000, meaning if we do the math, that'll come out to a trade size of $27,500 with an exit loss trigger of $2,500. So we're risking $2,500 on the position. So our demonstration month is going to be right here in June of 2020. The entry date on this is going to be Wednesday, April 15th, 2020 at 15:30, which is 3:30 in the afternoon. Now, for those of you who are not familiar with a analytical matrix, this is a software called OptionView, and it shows us the expiration months of various option cycles across the top here. What we're trading this cycle is going to be the June expiration, and they expire on June 19th, and they are currently 65 days to expiration on April 15th. Okay, the asset price is currently $1,089, and we're going to come in here and we generally look at it to sell an option that's about 10 delta, and then we go 30 points lower. And usually that gives us about $2.50 credit, but that is going to depend on the market environment. And the type of market environment we're in right now, it's actually, it's going to take us about a 7 delta call here to give us a $2.50 credit. So we're going to enter this position here. Now this tells us our gain and loss right here under the gain and loss. And other than that, the Greeks really are irrelevant within the way we manage the trade because there are no adjustments to this strategy. If we look at our analyzed graph, this is what that looks like. Let me back this out or zoom out, so to speak. And what we're going to end up here is you can see this is the short strike that we sold. This is the one that we bought. Along the bottom here is represents the asset price of the Russell 2000, and the solid line right up in here is going to tell us the value of this position on our expiration date at any given price point in the Russell, should we let the trade go that far, which we are not. The dashed line that's right in here tells us or gives us an approximation of what our value is going to be worth with any given move of the Russell 2000. And you'll notice right now we're slightly underwater. That's because of the commissions that we pay going in. Now over time, this dashed blue line is going to try and meet the solid line. And that being the case, what can happen here is we will make money, obviously, if the price goes up. If the price sits here, eventually this blue line is going to migrate towards the solid line and we will make money. And even if the market goes down a fairly substantial amount, this line does go up quite a bit. So we could make money with even a substantial down move here. Now, as of right now, if the market went down right away, it's projecting a stop out point of about 1075 here on the Russell 2000, assuming the profit and loss actually follows what the projection is, which doesn't always happen, but usually it's fairly close. All right, so let's take a look at, well, if we were going to look at this position, basically the market ended up from here. It didn't stop out. This was a winning position. But there are some interesting points that I'd like to just quickly note here. And I think one of them was April 29th. So let me go here. And at this point, the market went from where it started all the way up to 1367. And if we take a look at our price chart here, you can see we entered on April, let me see if I can get the date here, April 15th, which was not this day, but this day here, which we had a little bit of lucky timing. We're almost at the bottom. That's not necessary. In other words, the market can go down quite a bit even on entry and we'll still be okay. But this happened, and we had the first day we were down a little bit, and then from there we're pretty much up. But this is a very substantial move. It doesn't look like it because this crash move was so big, but this is a very, very large move for the Russell 2000, for those of you who are not familiar with the index. Anyway, we're up here at 1367. We go to the following day. A 50-point drop, 1367 to 1317. We go to the following day. We're all the way down to 1253. So we started at 1367. 2 days later, we're at 1253. That's what, 112, 113 points, somewhere in that range. That is a huge, huge down move for the Russell 2000. Now, notice that we're still up $1,500. despite the fact we're in a bullish trade and we got a down move. That's pretty impressive. Now, one of the challenges that traders have when they talk about trading the bull trade, or I tell them how effective the bull trade is, they say, well, if the market goes down, I'm going to lose. And I say, yes, if it goes down enough, you're going to lose. In other words, it can go down some and you'd still be okay, but it's true. If it goes down enough, you are going to take a loss in the position. And to that I say, well, so what? Some trades are going to lose. And they say, well, I'm concerned about down moves. I'm afraid of down moves. So I want to go into a delta, what they call a delta neutral trade, where we enter and the T plus zero line essentially has zero delta, or in other words, a small movement in either direction really doesn't hurt the position. And a lot of people do that and they'll put on an adjustment strategy. And in fact, a lot of our trading strategies do that. But one of the challenges is if you are truly afraid of a down move, then a lot of times what happens is if you're in a delta neutral position and you get a big up move in the market, then you don't make any money. You may even be drawn down a little bit of money. So what they do to deal with that, or in order to make money after the price has moved up, is they're going to make up adjustments. They're either going to take the whole position and move it, or they're going to make some sort of other up adjustment. Now, when we make an up adjustment in these positions, what happens is the downside becomes more vulnerable. Meaning that if we get a big up move like we just got, and you were in the type of position that was very neutral, and you happen to be, maybe at break even or drawn down because the market just kind of kept moving, it never really sat. Then what happens when you get these big down moves? A lot of times is that they'll lose. They'll lose because you adjusted them up in order to try and make money up where the price is now. The result being you lost with a down move. This trade, however, experienced this really, really big down move and is still up $1,500. That's because it has a little bit of a delta directional component to it. And if things go in the right way, since we're not adjusting up, the price can literally come all the way back to where it started, and you can still be up money. As a matter of fact, you can go even further down than when it started, and you can still be up money. A lot of times, a neutral strategy is not going to handle that. So you need to think about that when you're doing it, because all you're doing by entering delta neutral a lot of time is hiding your risk. You're hiding it from yourself because you're still going to lose at times. It's just that the scenario under which you're going to lose, or the timing of a down move, for example, is going to be vulnerable at different times. So just keep that in mind when you're doing your neutral trades, or you're trying to compare a neutral trade to takes on a little bit of delta in one direction or another. Okay, they all have their winning and losing scenarios. So anyway, nothing else happens with this till our July expiration here gets 65 days to expiration. That is actually going to happen on the 13th. So when we come to the 13th, this is what we look like. The position is up $1,840. Notice this is a big down day as of this day here, and but it's time to exit because we're 65 days to expiration for July. It's time to enter our next trade, and we will just close this trade at about an $1,840 profit minus whatever the commissions are going to be, and that is a nice winning trade. Now, what do we do for the next month? We simply come in and we do the same process as we did before. We find a 30-point spread here that gives us about $2,500 credit because we're doing a 10 lot, and we do the same thing. I also want you to notice too, this trade wasn't very difficult. We put the position on and we took the position off, and as far as monitoring goes, the only two or 3 days during this whole period, I think the trade probably lasted 30 actually we went 65 days to expiration to 37, so it lasted 28 days. So in this 28 days, you put on a trade. You probably checked it 2 days because right away the market went down a little bit, so you may have wanted to check it, but you didn't really need to because it didn't go down that far. The market bounced a little, came back down, but never really went lower than where we started. So you really didn't even have to check this position, other than just kind of knowing where the market went on a particular day until we have to actually exit it due to a time situation. So to me, I love that. I love that. That's absolutely fantastic. That was the winning trade for this month, the bull trade, and I'm excited to see how the next cycle turns out. Now, if you like what you see here, I encourage you to join us and discover how you too can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming winning trade presentations, get special bonuses with the upcoming winning trade presentations, and perhaps best of all, you can get information about our free Trading Performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on the video below or contact us at lockinyoursuccess.com, and we can get your questions answered for you or cover information that you'd like to see. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as a lot of other fantastic bonus information on how you too can profit through income trading. And please remember to subscribe and comment on our YouTube channel, where I will personally answer any question you may have. Thank you, and we'll see you on the next winning trade.